Welcome to FIRE's educational video series. The objective of this video is to introduce the concept of channel, discuss its different types, and talk about how to trade channels. Channel is a continuation to the concept of trend line which we discussed in the previous few videos. Hence, if you are new to learning channels and have missed the videos on trend lines, we highly recommend you visit those videos first before watching this video. In the previous videos, we said that there are three types of trend lines. In a similar manner, channels could also be split into three types: rising channel, falling channel, and sideways channel. In this video, we will talk about rising and falling channel. We will cover sideways channel in a later video when discussing about classical price patterns. Let us start with a rising channel first. To draw a rising channel, you need to draw two lines. The first is the main trend line which connects two successive rising supports, and the second is a parallel line drawn touching the first peak that is between the two draws. Let us understand this using a hypothetical chart. As the price here has bounced from the second low, we can assume that this low is in place and a trend line can be drawn connecting these lows numbered 1 and 2. Once this trend line is drawn, you immediately copy that trend line and paste it at the top of the first high that is in between the two draws. Here, the first high is marked as 3. What we now have is a parallel line to the main line. In other words, we have a rising channel. If the price retreats after touching the parallel line, the rising channel is confirmed to be in place. The objective of drawing a parallel line to the main line is to find out the region where the price rally could halt and probably turn lower. So, see that when the price is trading within the rising channel, the trend of the security is higher. The two lines act as a dynamic area of support and resistance, with the main line acting as a support and the parallel line acting as a resistance. How do you trade once a rising channel has been established and confirmed? Well, because the security is trending higher, you would be looking at buying opportunities. When the price is trading within a defined rising channel, you can buy the security once the price bounces off the main line and use the parallel line to exit from the long position. As long as the price is trading within the channel, you can trade using this strategy. In this chart, points 2, 5, and 7 can be used to buy, and points 4 and 6 can be used to exit from those long positions. Contrarian and risky traders could also consider establishing short positions at points 4 and 6 and use points 5 and 7 to exit from these short positions. However, keep in mind that such strategies are risky because you are trading against the overall trend. Price does not always move within a channel. At some point or the other, it moves out of the channel. If the price breaks below the main line of a rising channel, it would signal at a change in trend from up to either sideways or down. If the break signals at a reversal in trend from up to down, as is the case in this hypothetical chart, it would warrant closing out all long positions and establishing short positions in the direction of the newly established downtrend. On the other hand, if the break signals at a change in trend from up to sideways, one should look out to exit long positions and wait for the price to either break higher or lower before deciding to act. In this hypothetical chart, the first warning that the uptrend could be weakening emerged when the price made a lower high at point 8. Later, price went on to break below the main line of the rising channel, further evidence that the uptrend has weakened. Finally, break below the low at point 7 formed a lower low confirming that the uptrend has now reversed into a downtrend. On the other hand, when the price breaks above the parallel line of a rising channel, it indicates an acceleration in the angle of the uptrend. However, before deciding to increase long exposure in the underlying, you need to confirm the authenticity of the break. To do so, you could use the strategies that we discussed previously in the videos on trend lines. Also, you should pay careful attention to the angle of the rising channel. Why is the confirmation of break and angle of channel so important before deciding to add longs? Well, because by the time the upside break occurs, a lot of price rise would already have taken place. Hence, if the breakout is not confirmed by other parameters, or if the angle of the rising channel is too steep, chances are that the breakout could be false. In such a case, there is a high probability that after a brief break above the parallel line, the price could reverse and fall back within the channel. Based on your interpretation of the chart, if you foresee the break as being genuine and the angle as not being too steep, you must look to buy the security. However, given the inherent risk in buying at such high levels, a stop loss needs to be placed in case the trade does not pan out as expected. In this chart, a stop loss could be placed a tick or two below 0.7, which is the immediately preceding swing low before the breakout. Once the price breaks below the main trend line of a rising channel, you can forecast the extent of the potential price decline. Because a channel comprises of two lines that are parallel, its width remains constant throughout. This width, which is measured as the vertical distance between the channel high and channel low, must be subtracted from the breakdown point to arrive at a rough price estimate of the potential price decline. In a similar manner, if the price breaks above the parallel line of a rising channel, the width of the channel must be added to the breakout point to project the potential upside target. However, in this case, you need to be more flexible with your targets. This is because by the time the price breaks out of a rising channel, a lot of price rise would already have occurred. If the channel is too wide or if the angle of the channel is too steep, then there is a risk that the upside break could be false and that the target might not be achieved. Hence, one needs to be careful when trading an upside breakout of a rising channel. In this chart, notice that two important lows are identified. A trend line is then drawn connecting these lows and projected into the future. Once the main trend line is drawn, a parallel line can then be drawn by copying the main trend line and pasting it above the swing high that is somewhere in between the two swing lows. Notice that in this case, the price rally from the second swing low halted at the parallel line and reversed lower. See that the subsequent decline found support at the main trend line on a few occasions before breaking below the main trend line. Once broken, the price target can be calculated by measuring the width of the channel and subtracting this width from the breakdown point. In this case, see that the price objective was almost achieved towards the fag end of the chart before the price reversed higher. This brings us to an important point. Price objectives are just estimates which may or may not be achieved. If a target is almost achieved, but then the price reverses before achieving the target, one needs to look at the weight of the evidence to decide whether the position must be held on to or whether profit must be booked. In this chart, once the two swing lows were identified, a rising trend line was drawn connecting these lows, and then a parallel line was drawn connecting the first swing high. Notice how well this parallel line acted as a resistance twice in the future. Meanwhile, notice the two false breakdowns. See that neither of these breakdowns sustained below the main trend line and soon reversed higher. In case short positions were established following these breaks, the lack of downside momentum and the subsequent emergence of strong green candles that took the price back above the trend line was a signal that the breakdowns were most probably false. In such a case, it would make sense to exit from the short positions. Towards the fag end of the chart, see that the main trend line was broken again before price went on to break below the previous low. Now, notice the weight of the evidence here. Not only do we have a break below the main trend line, but this break was then followed by a lower high and a lower low sequence. This was a signal that the trend has reversed from up to down and warranted establishing short positions. The minimum price objective of the channel breakdown can be calculated by measuring the width of the pattern and then subtracting this width from the channel breakdown point. In this case, when the price achieved the channel objective, see that a gap down candle emerged. The emergence of such a gap down candle indicates a strong selling pressure. In such a case, it would make sense to hold on to the short position and trail the stop loss lower. This brings us to an important point. If the price objective of a channel is achieved, do not immediately book profits. If the prevailing trend is strong and if it looks likely to continue than reverse, it makes sense to hold on to the winning position and trail the stop loss in the direction of your position. Remember, the price objective that is determined is the minimum price objective and not the maximum price objective. Let us now shift from rising channel to falling channel and talk about its construction. To draw a falling channel, you need to plot two lines. First is the main trend line connecting two successive falling resistances, and the second is the parallel line drawn touching the first draw between the two highs. The objective of drawing the parallel line to the main line is to find out the region where the price decline could halt and probably turn higher. See that when the price is trading within a falling channel, the trend of the security is lower. The two lines act as a dynamic area of support and resistance, with the main line acting as a resistance and the parallel line acting as a support. How do you trade once a falling channel has been established and confirmed? Well, because the security is trending lower, you would be looking at selling opportunities. The idea is to short the security once the price has taken resistance and reversed lower from the main trend line, and to then exit these short positions at or near the parallel line. In the case of this hypothetical chart, one should be looking out to sell near points 2, 5 and 7 and exit these short positions at or near points 4 and 6. Contrarian and risky traders could also consider establishing long positions at points 4 and 6 and use points 5 and 7 to exit from these long positions. However, keep in mind that such strategies are risky because you are trading against the overall trend, which is down in this case. When the price breaks above the main line of a falling channel, it would signal at a change in trend from down to either sideways or up. As shown in this chart, if the break signals at a reversal in trend from down to up, it would warrant closing out all short positions and establish long positions in the direction of the newly established uptrend. On the other hand, if the break signals at a change in trend from down to sideways, one should look to exit short positions and wait for the price to either break higher or lower before deciding to act. A warning that the downtrend could be weakening emerges when the price makes a higher low within the channel and then goes on to break above the main line of the channel. Confirmation of a trend reversal from down to up emerges when the price makes a higher high as well, thereby breaking the sequence of lower low and lower high. In this chart, such a confirmation emerged when the price broke above the high of 0.7. When price breaks below the parallel line of a falling channel, you should analyze that break closely. The breakdown must be validated by using other technical parameters, and it must be seen that the angle of the falling channel is not too steep. If you foresee the break as being genuine and the angle as not being too steep, you must look to sell the security. However, given the inherent risk of shorting at such depressed levels, a stop loss needs to be placed at all costs. In this chart, a stop loss could be placed a tick or two above 0.7, the immediately preceding swing high. Once the price breaks above the main trend line of a falling channel, you can forecast the extent of the potential price rally by measuring the width of the channel and then adding this width to the breakout point. Similarly, if the price breaks below the parallel line of a falling channel, the width of the channel must be subtracted from the breakdown point to project the potential downside target. In this chart, notice the falling channel in action. The upper line of this channel is the main trend line, while the lower line is the parallel trend line. Notice how well the parallel trend line acted as a support on 3 occasions from where the price bounced strongly. Eventually, once price broke above the main trend line as well as above the immediately preceding swing high, it indicated at a reversal in trend from down to up. Before the break, observe how the failure of price to touch the parallel line indicated that the selling pressure is slowing down. Here is a falling channel plotted on a line chart. Notice how well the parallel line acted as a support before the break above the main trend line. The purpose of this chart is to show that a channel can be drawn not only on bar or candle chart but also on a line chart. Also, post the breakout, notice how the main trend line switched its role from resistance to support. This is nothing but the change in polarity principle. Let us conclude this video on channels by highlighting some key points related to channels. A channel could be rising, falling, or sideways. A channel comprises of 2 lines, one main line and one parallel line. The main line is drawn first and the parallel line is drawn immediately after the main line has been drawn. One should trade in the direction of the channel. Once a channel has been established, approaches towards the main line should be used to create positions in the direction of the channel, while those toward the parallel lines must be used to exit positions and book profits. Channels do not hold forever. At some point, they are broken either against the channel or in the direction of the channel. Often, price behavior within the channel can provide subtle clues as to the direction of the break. That said, one must not preempt the break, but should rather wait for the price to break in either direction of the channel and confirm the validity of that break before deciding to act. Finally, get into the habit of drawing a parallel line whenever you draw the main trend line connecting 2 important points on the chart. Often, you will be surprised to see how well the region around the parallel line ends up acting as a barrier to price. Well, that was all that we wanted to talk about in this video. If you liked our video, do not forget to click on the like button below. Also, hit the subscribe button to subscribe to our YouTube channel and the bell icon to receive regular updates from our side. Last but not the least, we have a dedicated space for School of Stocks related discussions on FIRE's community. We encourage you to interact with us on School of Stocks community page by visiting the link shared below. Thank you for watching this video.